Welcome to this explainer on stock splits. Today, we're peeling back the onion on the highly visible corporate action to reveal the high-stakes, behind-the-scenes operations that actually make it happen. We aren't just looking at the flashy headlines you see on financial news networks. We're getting right into the technical nitty-gritty, the mechanics, and the math that keeps global financial infrastructure running smoothly. Picture this. It's first thing in the morning. You check a client's portfolio and bam, their holding in a major tech stock has literally doubled overnight. Your immediate instinct might be to look for a massive unrecorded trade. But then you notice something else. The price of that stock has been cut exactly in half. It's not a glitch, and nobody made a mistake. What you're looking at is a classic stock split, or what's sometimes called a subdivision. In the world of global financial operations, we actually tend to call this a cosmetic exercise. Why? Because while the numbers flashing on the trading screen look incredibly dramatic, the underlying value of the investment hasn't moved an inch. At its core, it's a technical equity restructure. The issuer is simultaneously changing the quantity of shares issued and the par value of those shares at the exact same time. You know the classic corporate pizza analogy, right? Let's use it real quick as our baseline before we get into the heavy balance sheet math. It's a staple in financial education for a reason, and it perfectly captures the value neutrality of this whole process. Imagine you've got a massive 12-inch pizza sitting in front of you. Cut into 4 giant slices, it's still just one total pie. Your total meal represents a specific finite amount of food. Now cut it into 8 pieces. It's the exact same amount of food, you just have more pieces to handle. A stock split is absolutely no different. The investor now owns more units, but their total market value at the moment of the split remains absolutely identical to what it was before. When we look at how this math actually hits the corporate balance sheet, it becomes remarkably clear. A 2-for-1 split replaces a $1 par value with 2 50-cent par value shares. $1 multiplied by 1 share equals $1. 50 cents multiplied by 2 shares still equals $1. The total capital value on the ledger is left completely unchanged. The company hasn't magically created new wealth. They've just restructured how that wealth is divided, which naturally begs a very pragmatic question. If the overall value is entirely neutral, why on earth do companies go through this massive operational hurdle? Changing the fundamental structure of your issued equity and coordinating with exchanges worldwide is definitely not a simple weekend project. Well, the answer is strategic capital management. By intentionally dropping the share price, say bringing a stock down from a heavy $1,000 a share to a much more digestible $100, the issuer makes their shares vastly more accessible to a broader range of retail buyers. It removes the friction of buying standard board lots, and this accessibility usually boosts overall liquidity and trading volume. Ultimately, it's a strategic marketing move designed to increase marketability, masquerading as a math equation. So let's dig into the global ratio trap, which happens when a 3-for-2 split doesn't always equal the same thing. See, market conventions differ wildly depending on geography. In the US market, a 3-for-2 split means your total holding becomes 3 shares for every 2 you previously held. Pretty straightforward. But jump over to European and Asia-Pacific markets, and that exact same 3-for-2 ratio usually means you receive 3 additional shares for every 2 you own, giving you a total of 5. Market practitioners have to be incredibly careful here. Using the wrong math based on the wrong regional convention isn't just a minor slip-up. It can lead to massive reconciliation breaks and completely incorrect client reporting. Next up in our back-office reality check, the effective date and transformation. The effective date is really the crucible of this whole operation. It's the exact day the old shares are completely deleted from the system, unsettled trades must be actively transformed, and the new shares are officially born. This isn't something that happens gradually over a week. It demands absolute pinpoint precision across global systems before the market even opens for trading that morning. To truly grasp the granular mechanics of this, let's look at the Xerox Corporation 2-for-1 split. It serves as a perfect real-world example of what happens to unsettled trades right on this critical effective date. Imagine you're managing the books and you have a pending purchase of 9,000 shares at a $1 par value. The trade executed a couple of days ago, but the actual settlement date lands smack in the middle of this massive corporate action. Your systems are waiting for shares that technically are about to stop existing in their current form. To keep the ledger perfect, the back office must undergo a highly controlled process called transformation. They have to effectively catch that trade in midair and reshape it into a pending purchase of 18,000 shares at a 50-cent par value. The vital part here? Keeping the cash consideration exactly the same. The buyer pays the same total amount of money they initially agreed to, but the physical units they receive upon settlement magically double to align with the new corporate structure. So how do internal systems actually handle this, software-wise? Generally, it's done through one of two methods. Firms either use the remove and replace approach, literally deleting the old security code and adding a brand new one to the system, or they simply use the adjust approach by updating the par value and the title right there in the existing database. Whatever the method, the ultimate goal across all operations is total, uncompromising precision. There is zero room for error. The crucial point boils down to this. Mastering stock splits isn't just about simple multiplication and division. It requires total command over the underlying mechanics. If you aren't in control of the par value and you don't deeply understand the specific regional ratio, you simply aren't in control of the position. And in the high-stakes world of global finance, a loss of control is simply not an option. Which brings us to our final thought for this explainer. As you think about all this hidden machinery we've covered, ask yourself, when the issuer decides to reslice the corporate pie overnight, are your systems and teams actually prepared to keep the books perfectly balanced? Will your records accurately reflect the new pieces before the morning bell rings? Because when the market changes the rules of the game overnight, readiness is absolutely everything.